The US dollar will never be the same. Treasury Secretary Scott Bessent just revealed that America is moving toward a blockchain-based dollar, the first real step toward a US CBDC. But as dramatic as that sounds, an even bigger storm is brewing in the bond market, one that could shake the foundation of this entire rally. Liquidity is evaporating at a pace we haven't seen in decades, and when bonds start cracking, stocks rarely escape untouched. Let's break down why this shift matters and why a sharp 5 to 6% pullback might actually be the healthiest thing for this market right now. Also, just so you know, I'm literally sitting here by a lake with this insanely beautiful view while recording this video. I'm out here fighting off bugs and sun glare just to get this recap out on time for you guys. I hope you at least appreciate the commitment, or at least hit the like button for the scenery. Today we'll dig deep into blockchain dollar news, dissect the cracks forming in the bond market, look at how retail traders are fueling this rally, and review what VIX seasonality is signaling for the months ahead. We'll also highlight next week's economic data and earnings reports that could shift the narrative. And similar to the last few videos, the chart and technical setups will be covered in the newsletter, which I will send out before the market opens on Monday. So make sure you're subscribed. Before we get into this week's price action, let's address one of the most significant headlines. Treasury Secretary Scott Bessent confirmed the US is moving towards a blockchain-based dollar, the first real step towards a potential CBDC. This is more than a technical upgrade. It could reshape the entire financial system. A US CBDC could disrupt the crypto market by competing directly with stablecoins, while in forex markets, it may strengthen the dollar's dominance as a global reserve currency or accelerate the push from BRICS nations to create an alternative system. For regular folks like us, CBDC means digital money under central bank control, raising both opportunities and concerns. On one hand, transactions could be way faster and cheaper. On the other hand, the level of oversight and control could erode privacy and financial freedom. It's a massive shift in how money could work, and while it might not hit stocks immediately, it's a game-changing development to watch. I'll dive deeper into this in a standalone video because it deserves its own breakdown. With that major headline in mind, let's look at how markets behaved this week. Stocks kept climbing as if nothing could touch them, but behind the headlines, there's a different story. Retail trading activity is at its highest level since 2018. Tesla and NVDA dominate the headlines, and AI hype is fueling momentum. Yet, the bond market, which is the backbone of global finance, is flashing red. And that brings us to the biggest story under the radar, bonds. Japan's 30-year bond yield hit a record 3.2%. This is the highest since it was first issued. This isn't just a Japan issue. It's part of a larger picture. Global bond liquidity has collapsed to levels worse than 2008 financial crisis. The Bloomberg Government Bond Liquidity Index, which tracks how smooth or difficult it is to trade government bonds, has doubled in recent months. In simple terms, a higher reading means the market is drying up. Fewer buyers and sellers, wider bid-ask spreads, and bigger swings just to execute a trade. So why should stock traders care? When bond liquidity dries up, borrowing costs rise, credit tightens, and risk sentiment shifts. The US 30-year Treasury is once again hovering at 5%. And if yields continue rising, high multiple tech stocks will feel the pressure first. While bonds are cracking, retail investors are charging ahead. Retail traders now drive 14% of all single stock volume, the highest share in years, even more so than during the meme stock mania. NVIDIA, Apple, and Tesla together make up over $1 trillion in retail holdings. While retail is chasing momentum, institutions are watching bond markets and quietly hedging. Beyond daily trading, there is a broader wealth story worth noting. Baby boomers hold 54% of US equities, while millennials hold just 8% despite years of bull markets. This wealth gap highlights how older generations continue to dominate long-term investment assets, while younger investors, facing higher living costs and slower wage growth, often resort to chasing short-term trades or speculative plays just to keep up. It's a generational divide that shapes risk tolerance, market behavior, and even how rallies and sell-offs play out. Tech and geopolitics are also shaping market sentiment. NVIDIA's decision to resume AI chip sales to China comes at a critical juncture as US export controls continue to tighten and Beijing seeks access to cutting-edge technology. CEO Jensen Huang's visit to Beijing highlights how strategic these relationships have become. The AI rally isn't just about innovation. It's about global power dynamics, supply chain risks, and government policies. If US-China tensions escalate, we could see these AI-driven gains unwind quickly as regulatory crackdowns and export restrictions ripple across tech sector. Politics also stepped into the market narrative this week. Donald Trump has declared Crypto Week, pushing the Genius Act and putting digital assets center stage in US politics. While this doesn't directly move equities, it adds another layer of speculation. Volatility is another key signal to watch. Historically, the VIX bottoms in mid-summer and then spikes heading into late summer and fall, a pattern I mentioned both in recent videos and the latest newsletter. With equities running in almost unbroken rally, a 5 to 6% pullback would actually be a healthy reset. This isn't a call for a top, but history shows we're entering a period where choppiness tends to return. I've already positioned with some put spreads on S&P 500 with August expiration, anticipating some downside. I'm also planning to pick up some VIX calls, though with a smaller position, as I expect volatility to push higher soon. I will send out a detailed breakdown of these trades before Monday's open, along with another list of fresh takers I'm watching, which I will send out on Wednesday. From last week's newsletter, nearly all of the takers I provided have been performing as described. So don't miss the free opportunity. Make sure you've subscribed to my free newsletter. With that in mind, all of these signals point to a market running hot. Stocks are still pushing higher, but the foundation, bonds, is unstable. Retail sentiment is euphoric, tech is stretched, and volatility could return. This is a golden opportunity to hedge your long-term portfolio and even explore some speculative downside trades, especially with VIX seasonality in play. With the VIX this low, you can buy that insurance, put or volatility plays at much cheaper levels. If you don't fully understand how this works, go watch my latest video on options trading where I explain the Greeks and how they impact strategies like this. This isn't the time to panic, but it is the time to tighten risk and plan your moves carefully. So far, if this helped you cut through the noise, hit like and subscribe. My free newsletter dives deep into the macro reasoning, chart setups, and large options flow. Use the link below to sign up and it's totally free. Now, with all that out of the way, let's see what we have on the economic and earnings front for this week. On Monday, we have US leading economic indicators. On Tuesday, we have Fed Chair Powell opening remarks at banking conference. On Wednesday, we have existing home sales. On Thursday, we have initial jobless claims, service and manufacturing PMI, and new home sales. On Friday, we have durable goods orders. On earnings calendar, on Monday, we have Verizon, Domino's, NXP Semiconductors, SmartBank, and many more. On Tuesday, we have Lockheed Martin, Coca-Cola, D.R. Horton, Philip Morris, General Motors, Texas Instrument, Capital One, RTX Corporations, and much more. On Wednesday, we have Tesla, Alphabet, AT&T, IBM, ServiceNow, Chipotle, Alaska Airlines, and some more names. On Thursday, we have Intel, American Airlines, Southwest, Honeywell, Nokia, Deckers, Newmont, and more. On Friday, we have Centene, Charter Communications, and more. As you can see, this is going to be a very, very busy week on the earnings front. So make sure you're following me on Twitter and also on the newsletter, as I will share any new breaking headlines both on Twitter and newsletter. As we head into next week, it's important to remember that this week's rally masks some key warning signs: collapsing bond liquidity, retail FOMO, and a seasonal rise in volatility ahead. This doesn't mean the rally is over, but it signals that now is the time to stay disciplined, hedge where needed, and plan for a healthy pullbacks. Markets remain driven by liquidity and sentiment more than fundamentals. Smart money is hedging quietly, and you should be thinking a few steps ahead. If you want the full breakdown and fresh trade ideas, subscribe to my free newsletter. The link is below. And if you're not fully comfortable with options or hedging strategies, go watch my latest video on options trading, where I explain the Greeks in detail. The link is also below. Thanks for watching, and I will see you in the next one.